Namaste. In this video, we'll discuss about Ind AS 34, that is interim financial reporting. So, objective of Ind AS 34 is to prescribe the minimum content that should be there in the interim financial report of an organization. It may be in form of complete set of financial statement or in form of condensed financial statements. Ind AS 34 prescribes the principles for recognition and measurement of different items in the financial statement for the interim period. And what is interim period? It is called as a shorter period as compared to the complete financial year. The purpose is to improve the ability to understand the entity's capacity to generate income, cash flow, and its financial position. So the purpose is that the users of the financial statement are not supposed to wait for the end of the complete financial year when the position of the company, its earning capacity, the revenue, cash flow status will be presented to the users. So the purpose is to provide in status of financial position, earnings, etc. during the financial year. So, if we talk about the scope of Ind AS 34, Ind AS 34 does not mandate that which entity need to present the interim financial reporting. It does not talk about the frequency of it and how soon after the end of the interim period the financial statements will be reporting will be done. So, the Ind AS 34 applies if the entity is required to or elect to publish an interim financial report according to Ind AS. So these are the different entities or the entity itself that decide or mandate that it has to present the financial statements, and if it decides or it is required to present financial statement interim financial statement, that then it has to follow the Ind AS 34. In most of the listed companies, SEBI requires that the listed companies are supposed to publish its financial statements. So financial report may be in form of annual or interim. So we need to evaluate its financial statement, financial reports on independent basis. So if we are talking about the annual report, that we have to evaluate on annual statement separately and interim statement separately in respect of the conformity to the Indian accounting standards. So if an entity is required to present the interim financial statement but it does not publish the interim financial report, so it does not prevent annual statement from being Ind AS compliant. So if an entity is required to publish the financial statement but due to any reason it has not published the interim financial reportings, in that case the financial annual financial statement will be called in compliance with Ind AS. Because as we have discussed that we have to separately evaluate the annual and interim financial statement. Similarly, if there is non-compliance in interim period, that does not affect the compliance of annual financial year if those meet the Ind AS requirements. For example, if any interim financial period the any requirement of Ind AS is not followed, but it is followed in the annual financial statement, so not following the Ind AS requirement in the interim period will not affect the evaluation of the annual financial statement that meets its requirement. So the final note is that annual statement can still be Ind AS compliant even if interim reports are missing or are faulties. So a statement of Ind AS compliance we need to disclose separately and only if complies with the all requirement of this accounting standard. So in case of interim financial statement also we need to provide the statement that it has been compliant with the Ind AS. Next is about the financial statement. So entity may decide to publish the complete set of financial statements in form of balance sheet, PL and OCI, SOKI, cash flow, comparative information, and third balance sheet if it is required. And if an entity opt to publish complete set of financial statement, that it need to be in conformity of Ind AS 1 requirement. And NDS 34 provides an option to the entity to provide minimum component of Indian financial reporting, and it will include BAS, PL, OCI, SOKI, cash flow, and selected explanation notes and key disclosures only, as compared to the complete set of financial statements. Here, the focus is that in the interim financial reporting, we should focus on new activities, event, and circumstances, and there should not be duplicity from the latest financial complete set of financial statement, because Ind AS 34 assumes that the user of the financial statements has accessibility to the latest complete set of financial statements. So there is no requirement to repeat those disclosures again and again. When an entity opt to provide the minimum component of in financial reporting, in that case, it shall include minimum each heading subtotals as were in the recent annual financial statements. If an entity's most recent financial statement were consolidated statement, so interim financial report will be prepared on the same basis. And if the annual financial statement includes parents separate financial statement in addition to consolidated financial statement, in that case, Ind AS 34 neither require nor prohibits inclusion of parents separate financial statement in interim financial statement. So in this slide, we can conclude that entity has option to publish either complete set of financial statement or minimum component of Indian financial reporting. So in that case, if it choose to follow the complete set option, in that case, it has to be in requirement of Ind AS 1. And if it opt for the minimum component, there, in that case, there should be minimum each subheading and subtotals as were in the recent annual financial statements. So if we talk about the disclosures, those are given in Ind AS 34. In that case, there are two types of disclosure. One is the for the significant events and transaction, and other is those disclosures are mandatory. So objective is to explain the significant event and transaction since the last annual reporting period only. So we are supposed to provide only significant events and transactions. Those have occurred after the annual reporting period. But in case of mandatory, we need to provide year-to-date disclosures for interim financial statements. And the nature for the significant event is to update the prior annual information, latest information about the events after the latest annual reporting period. And in case of mandatory, additional explanatory information is required. For example, in the routine routine transaction, we need to disclose about the inventory write-downs, devaluations, impairments, restructuring provisions, PPE, defaults, related party disclosures, and capital commitments, etc. But in case of mandatory disclosures, we need to state that same policies and methods are used in the interim financial reportings. And if there are some unusual items, we need to disclose them and change in the estimates, debt and equity movements, dividend segment information if it is required as per 108, and events after the reporting periods, business combinations, fair value disclosures. If these transactions have occurred, we need to mandatorily disclose these transactions. And in case of disclosure locations, we need to provide these disclosures in the interim financial reporting, but mandatory disclosures may be presented in with cross reference to some other statements. Those are presented with interim financial statements such as management commentary or risk report. But it must be available on same term and time. So if we talk about the period presented in case of balance sheet, it should be at the end of current interim period, and comparative information should be provided at the end of immediately preceding financial year. For example, if this is a balance sheet of Infosys, in this case, it has presented the 3 months and 9 months ended 31st December 2024. So in this case, the Balances are at the end of 31st December 2024 and preceding financial year is March 2024. So the current end of current financial year, that is December 24, and at the end of immediate preceding financial year, that is ending on March 24. So if we look again, it is December 24 and March 24. And in case of statement of profit and loss account, we need to present the current interim quarter. So it will be December 24 in this case and financial year to date. It means YTD December 24. And comparative, we need to provide the same interim period, that is December 23, and YTD immediately preceding financial year, that is YTD December 23. So here if we check that 3 months, December quarter for 24 and December quarter for 23, and 9 months, that is YTD December for 24 and 23. And in case of SOKI and cash flow, we need to provide year-to-date change in equity for current financial year. Similarly, for preceding financial year, if we check here, it is provided for December 23 and December 24. This is the SOKI and this is the cash flow for 9 months, 24 and 23. And in case of notes, we need to provide the explanatory notes on the significant events as we have discussed earlier. And there is no compulsory requirement for providing the comparative figures, but where it is required to give for the better understanding, for the understanding of the users, we need to provide it. So, and in case of this is a special case in case of seasonal business option, although it is not mandatory, it is suggested that we need to provide the 12 months financial information up to the current financial year and similarly for the last year. So if we summarize this slide, so balance sheet will be provided point in time, that is current versus last, and PL will be quarter plus YTD with the comparative figures, and SOKI and cash flow will be YTD basis along with the comparative figures. So next concept comes about that we have discussed that we need to provide the material information, and this materiality will be just based on the interim period data, not based on the annual. And for interim measurement, we need to rely on estimate on greater extent on the annual statements. And in case of Ind AS 1 and Ind AS 8, that require disclosure of mandatory items, red policies, estimate, errors, discontinue operations, but what is the materiality? There is a no threshold given in any uh, India. So we need to judge what is material and what is not from the perspective of the users of the financial statements or based on the legal requirement if there any about the disclosure of the facts. And in case of unusual items, change, error, we need to disclose for the interim period. And the ultimate goal is that the financial reporting that we are doing, there should be relevant and understanding should be there to the users of the statements to avoid any misleading informations. And we need to disclose in the annual financial statement if interim estimate change. We need to disclose the nature and amount in the annual financial statement if the separate financial statements have not been issued. For example, company has issued the interim financial reporting for March and there is some estimate change, but the annual financial statements have not been issued. In that case, company has to disclose the nature of and amount of the estimate change in the annual financial statement in form of note, and there is no need to provide the extra interim financial statements. And if we talk about the recognition and measurement principles in interim financial statements, so we need to follow the same accounting policies that have been applied in the annual financial statement. And the objective is to change made after the last financial year to be reflected in next annual financial year only, and frequency of reporting does not affect the measurement. It has to be on YTD basis, and interim estimates may change across the period. So similarly, in case of the recognition principle, we need to recognize the items of expense, income, assets, and liabilities if it meets the definition of the recognition principle as given in the NDSs and conceptual framework of to the NDS. So in case of assets, if future economic benefits test same as annual, and liabilities that it must exist on the interim date, and revenue expenditure should be recognized only if meet the recognition principle, and no items outside definition should be recognized, and there is no deferment of income or expenditure is allowed if it meet the recognition criteria, and prior period estimate are not adjusted, and we need to disclose if there is a significant change from in the estimates. It has to be adjusted in a similar fashion as we adjust in case of separate financial statements. So let's take one example on this matter. The Innovative Corporation Private Limited, or ICPL, is dealing in a seasonal product and sales pattern of the product, and quarter wise is under during the financial year. Sale pattern is as given in the this table. Quarter one they are expecting 10%, quarter two also 10%, quarter three they are expecting there will be 60% of total sale, and quarter four there will be sale of 20% they are expecting. For the first quarter ending June X1, ICPL has provided following information, and sale is 70, employees benefit are 25, and administrative and other expenses are 12, and financial cost is of 4. So ICPL, while preparing the interim financial report for the first quarter, wants to defer 16 crore expenditure to third quarter. These two expenditure they wants to defer on the argument that the third quarter is having more sale. Therefore, third quarter should be debited by more expenditure considering the seasonal nature of the business, and the expenditure are uniform throughout the quarter, and we need to calculate the result of first quarter as per Ind AS 34. So as we have discussed in our earlier slide, that revenue, assets, liabilities, expenses we need to recognize if they meet the recognition principles, and there is no deferment is allowed. So if we check this, seasonal income will be recognized when they occur. Therefore, argument of ICPL is not correct, considering the principle of Ind AS 34 as there is no deferment allowed. So, while calculating the profit, they have considered the 16 crores of the expense that ICPL has asked for deferment. Next is seasonal or occasional revenues. We need to recognize as earlier we have discussed about the recognition principle when they occur and there is no anticipation or deferment that is allowed. And in case of uneven cost, we need to defer only if the appropriate at the end of the period that is presented. And in case of tax expenses, there is a specific provision is given that we need to recognize on the best estimate of weighted average annual tax rate expected for the complete financial year, and the amount accrued for the income tax expense may have to adjusted in subsequent interim period based on the change in the estimate. So the income tax expense recognition will be done based on the weighted average annual tax rate, and we need to change the estimate also. So let's take one or two example about it. Company A has reported 60,000 as a pre-tax PBT in first quarter and expect a loss of 15,000 each in subsequent quarter. And it has a corporate tax slab rate of 20% in the first 20,000 of annual earnings and 40% of the all additional earnings. So we need to calculate the tax to be shown. So here we need to find out what is the expected tax rate, and to calculate the expected sales rate we need to estimate the annual profit. So in this case, the we are expecting there that in next 3 quarters there will be a loss of 15,000 each. So 45,000 will be the loss, and current year profit is 60,000. So expected total income is 50,000 for the year, and it falls in the tax slab rate of 20%, because up to 20,000 there is a 20% tax rate. So in this case, the expected tax rate will be 20%. So the tax is expected to 3,000, and annual income that we are expecting is 20,000, 15,000. So average rate is 20%. So based on the average 20% rate, in the first year we will recognize a tax expense of 12,000, and in case of loss we will be reverse it to 3,000 in each quarter. Let's take one another example. ABC presented interim financial report quarterly on X1. ABC Limited has carry forward loss of 600 lakhs for income tax purpose, for which deferred tax assets has not been recognized. Okay. And ABC earns 900 lakhs in each quarter, excluding the carry forward losses, and income tax rate is expected to be 40%. So we need to calculate the amount of tax expense to be reported in each quarter. So we need to first calculate the annual income that we expect, taxable income. So in that case, the 900 each into 4, it is 3,600, and there are 600 lakhs income tax losses that we need to carry forward. So taxable income will be 3,000 lakhs, and the tax slab is 40%. So 3,000 into 40% is 1,200 lakhs will be the tax expense. So effective rate is 1,200 divided by total income. So it comes around 33.33%. So tax expenses that we need to shown in each quarter is of 300 lakhs based on the weighted average annual tax rate. Next principle is about the reversal of impairment loss on goodwill. So as we have earlier discussed, that we need to follow the same accounting principles as we have we need to follow the following annual financial statement preparation. So in case of annual financial statement, if goodwill impairment is recognized, there is no provision of reversal. So the similar principle will apply in interim financial statement also. So if the goodwill has been impaired and it has been recognized in previous interim financial year, and situation changes in the next quarter, in that case also we need to follow the same principles, and there will not be a reversal of impairment loss on the goodwill. So next is okay, so let's take one example on it. ABC Limited manufacture automobiles. ABC Limited has shown a net profit of 20 lakhs for the third quarter, and following adjustment are made in while computing the net profit. So bad debts of 1 lakh incurred during the quarter. 50% of the bad debts have been deferred to the next quarter, so this is not allowed. Deferment of expenditures are not allowed in AS34, and there is an additional depreciation of 4 lakh 50,000 resulting from the change in the method of depreciation. So this is allowed. And exceptional losses of 28,000 incurred during the third quarter. 50% of exceptional losses have been deferred to next quarter. This is also not allowed. And 5 lakh expenditure on account of administrative expenses pertaining to the third quarter is deferred on the argument that fourth quarter will have more sale. Therefore, fourth quarter should be debited by higher expenditure. The expenditures are uniform throughout the year, irrespective of the sale amount. When dealing with the items of assets, liabilities, income, or expenditure, we need to follow the recognition principle. So it has to be recognized based on the recognition. If it is incurred, so we need to recognize it irrespective of the sale amount. So this treatment of this company is not correct. So here if we check in case of bad debts, we need to deduct it, and depreciation is correct as it is in compliance with AS34. Treatment of exceptional item is not as per Ind AS, so we cannot defer it. It should be deducted. And income and expenditure should be recognized when they are earned, so we cannot defer this amount also. So next is about the treatment of accounting policy change. So there are two type of accounting policy change. One where the retrospective application is possible. In this case, we need to restate the prior interim period of the current financial year, similar the prior comparable period also of last financial year. So this is that the same accounting policy is followed throughout the financial year and prior period date is fully comparable to maintain the consistency and understandability of the financial statement. So we need to change the comparative figures if it is possible, and if retrospective application is not possible, impracticable, so we need to adjust the interim financial period of the current year and comparable period of the prior period prospectively from the date from where it is practicable possible to apply it. And we need to apply new policy from the earliest date that is feasible, and we need to avoid the multiple policies in one financial year, and we need to ensure the operating results are not obscured and interim information is understandable. And purpose of this goal is that single policy per transaction class per financial year, and retrospective effect is preferred, and prospective only if the cumulative effect cannot be determined, and we need to avoid the interim allocation issues and should ensure the comparability and clarity. This is the total purpose of this treatment of accounting policy change in the interim period. And this is all about the Ind AS 34 interim financial reportings. And if you have any questions and need any clarification of the matter that we discussed, or have any questions, need any clarification regarding any questions that we have discussed, so you may contact on the given WhatsApp number or may comment on the video also. Thank you.